Hi everyone, Billy here, the co-founder of Trade Prosper, and welcome to section 11, video 2. We're continuing our section about how to trade trends using options. Just as a quick reminder, we have three different types of trend entry levels that was shown to you by Mike. One is the price crossing a moving average line. The other one is the two moving averages crossing each other. And the third one is a channel breakout strategy. Now the point is, it doesn't matter which one of those strategies you follow. All of them will follow the same sequence or the same decision-making process as we have shown in our previous video. In other words, the option strategy is a complementary strategy to the trend trading technique, and it doesn't replace any decision-making. All we are trying to do is to add some time to the equation so that we can avoid the interim spot volatility that might exist along the way. Also remember that we'll be using call options whenever we want to express a long position in the underlying, and we'll be using put options whenever we want to express a short position in the underlying. So in other words, if the trend technique indicates a breakout to the downside, we will use a put option. Now the question was, once we've decided we want to use an option, the choice is what strike rate are we going to use for the option? Now remember, we are complementing the strategy here. We are not trying to change anything of the underlying decision-making process. So whatever level the channel breakout strategy would indicate as your entry level, so looking at this example where we looked at a 55-day channel breakout to the downside, the 55-day level itself actually is the level that we want to enter the transaction with. So ideally what we're trying to do is we will buy an option. In this case it will be a put option, because our trend is expected to break to the downside. So we'll be buying a put option, and if possible, at or very, very close to the level of the breakout indication level that we're looking for. So in this case, the 55-day channel breakout. Now it's important to remember that in this particular instance, the idea here is not to trade the option itself. Whether you off by $1 or so doesn't make a real big difference. So you can choose a strike rate which is at the 55-day breakout level in this example, or a little bit below, or even a little bit below that. The point here is, you can see on the graph here, we were trying to capture the trend, or the direction of the trend was to the downside. So any strike level that we chose here would still give us ample exposure to the general move when it occurs. So once we hit the maturity date of the option, you will see that if the trend materialized, all three of those strikes, doesn't matter if we chose the 55-day channel breakout or a little bit below that, all three of those strikes would actually give us the benefit of still being in the trend or making our profit from a downward trend as we expect it to be the case. This is one of the few strategies where the strike rate is kind of given to us already. And I want to reiterate the fact here. The channel breakout level that we will use as our entry level is the same level that we're going to try and pick a strike that exists close to that level. And I'll show you an example on an actual pricing screen later. Okay, so now that we've addressed the question about which strike rate to choose, the only remaining question really is, how much premium shall we spend on this option? This particular course, we don't go into great detail about option pricing itself, but what I'm going to explain to you here is fundamentally valid for the strategy and the concept we're trying to achieve here. So it works for the purposes of this example. So in summary, this is kind of the only time when we use options where the actual strike rate and the price isn't driven by the option itself. And what I mean by that is, we didn't look at the option per se and say we want to choose this option over that option. We said we wanted to create a platform for us to expose ourselves to this trend, and the trend dictates which option to choose. In our example here, it will be a put option. And now we say the channel level itself will be the strike rate. So there already the strike rate is given to us. And now we'll just see how much does that strike rate cost. In other words, the price is already attached to that strike rate. And we'll just now evaluate the price if it fits within our risk parameters. So there is some flexibility. We'll adjust the price if needs be, but that'll become clear as I show the example now. So just to recap where we are in terms of the decision-making process, we've already now identified the trend. We've identified the setup that puts us to the point where we're now about to take action. And we already decided we're going to use options instead of the underlying. So with that, there's two choices we need to make. Are we going to put a strategy in place that's aimed or geared towards avoiding us being stopped out too soon? Or are we going to look for a strategy that provides us the leverage aspect of what options can provide? Now for this particular section, we are only focusing on the first part, which is avoid being stopped. So I'll continue on with an example from there. Now I want to have a caveat and be very, very clear about this point. This is the only time in this particular technique, so in other words, where we are trying to avoid being stopped. So we have a trend trading strategy, and we're putting an option in place with the idea of trying to just add time to the equation. Nothing else. We're just trying to add time to the equation, to our decision-making process, and avoid being stopped. This is the only time that we are not going to worry a lot about which strike rate of option to choose, and also what price we're going to use to pay for the option. And the point here is, or the reason for that being, is we're not trading the option. We're in fact anchoring a point, or as an entry point rather, so that we add time to the equation, and that gives us the ability to then look back in time. Once the option matures, we look back into time and say, wow, that's an awesome trend, let me get into it. So the option here is more a mindset per se. It gives us the ability to have that freedom to see if the trend develops, and if it develops, it puts us right back into the level that we would have been in had we followed a traditional trend trading strategy. All right, so the decision-making process for option premium, I've already explained to you, is not driven by the option itself. It's driven by the fact that our trend analysis, or our trend trading technique, the breakout technique, has already identified the level of the strike that we need to look for. Now what we will do is evaluate that strike in terms of its own premium. So whatever that strike is that we're targeting, how much does it cost? And we're going to look to that premium if it fits within our own risk parameter. So if you have a 1% risk of capital rule, you have to make sure that the premium that you spend on this strategy fits within that, so that if you have $20 to spend, you can't go and buy an option for $100. Certainly not in this example. In some of our other courses, we go into quite a lot of detail how to structure specific trades, especially if you have little premium to spend. But for the purposes of what we're trying to achieve here, we want to catch a big or a broad trend. So we're going to be buying an option, a call option if the break is to the top side, or a put option if the break is to the downside. And here the point being is that particular strike with that premium attached to it has to fit in our risk parameter. So let's have a look how we would calculate that. If we go to our risk calculator, you'll follow the logic here. We'll look at our portfolio value times our risk parameter tells us what is the maximum risk per trade. Now I've shown you already that if you have a $2,000 account and you can risk 1%, then the total amount of risk that you can take is $20. So technically, the maximum net premium that you can spend on an option here is $20. Now I want to be very clear here again. Remember, I'm only talking about this specific strategy here. This is specifically aimed or geared towards avoiding being stopped out too soon. You'll see some of the other strategies that we're going to address later. For example, the stock replacement strategy. This premium aspect is viewed a little bit different. So in this case, we physically write out a premium. So in our mind, it's kind of, we upfront put the money on the table that we are willing to risk. And in this example, it has to be in line with your 1% rule or your 2% rule, whatever your comfort zone is here. In our next video, we'll have a look at an actual options pricing screen and see how we can identify the right strike to choose. This is Billy from Trade Prosper, and I'll catch you in the next video. Thank you.